I think one of the most significant things that we've seen happen this week in the equity, bond, commodity, and foreign currency markets is something that's happened in the U.S. dollar. This is important because you have to look at both the technical side as well as the fundamental side to see what the real story is. From a fundamental side, we see extreme deterioration in the dollar. If you look at current Treasury flows and the interest which foreigners have had in the U.S. Treasury market, of course, that impacts the dollar negatively or positively depending on whether or not people are buying or selling. If you go back, scroll back, if you will, to June of last year, what you'll see is a reduction in exposure specifically by the Chinese Treasury. They've dropped about 12% of their holdings. It was north of $1.3 trillion, and now it's at about $1.15. They've dropped about 12% since June, with about $100 billion in liquidations between November and December. And so that's on the fundamental side. Now, toggle over, if you will, to the technical side of the U.S. dollar market, and the price of the U.S. dollar has just broken above the 50-day moving average. And what that indicates to us, and certainly traders across the world are saying, what does this mean? If the dollar is moving above a considerable moving average, does that mean we have a new uptrend in the dollar? Well, for us, we would say ultimately, no, we do not. But in the short term, we could still see prices rise on a very ephemeral basis, not on the basis of fundamental strength, not on the basis of the U.S. getting its house in order, but it can still move higher. That's one of the reasons, Kevin, why you're seeing massive volatility in the gold and silver market today and this week, because people are looking and saying, okay, if the dollar's moving higher, does this mean that gold and silver are moving lower? Question mark. That's the question that people are asking in the market. What they don't realize is how close we already are to a bottom in both gold and silver.
And David, wouldn't you say that the downside on gold and silver is just very marginal compared to the upside? I mean, if you were to make a call right now, I'm going to put you in a corner here and just say, give us some numbers. What's the downside on gold and silver? What's the upside? And does it pay to continue to hold even the shorter-term positions?
Well, you have to know that you look at gold and silver differently than you do some other assets. I'm sure that some of our listeners look at it and say, I bought gold yesterday, I want to sell it tomorrow at a profit, and that is their motive, growth only. For most of our clients, it's actually quite different than that. They own gold and silver as an insurance policy, and price is less important. So I think that's worth saying just as a caveat because of the internal or the intrinsic nature, if you will, of the metals as a wealth preserver, as something that is counter-cyclical, as we've talked about even last week, looking at some of the characteristics that are driving gold today in a low negative real rate of return environment. Gold and silver tend to do well. We could rehash everything that we talked about last week, but I just refer you back to last week's comments. The point is this, and to your question, Kevin, yes, we do see growth potential in the short term, and I'd say, let's talk about gold first and then silver. I'd say your downside is roughly 5% from here, and that assumes that we don't turn around and race to the upside from here. Yet we've gotten to a critical support level this week. If it doesn't hold, your worst-case scenario is roughly 5% underneath these levels. So am I concerned? Absolutely not. Am I inspired? Actually, very excited about what's happening in the metals market. It pays to have liquidity. This is why we've emphasized liquidity in the investment triangle, the perspective triangle, because it's in weeks like this that you get to pick the bottom, if you will, within the market. Now, again, if it's not this week, it's next week, and it's 5% lower. Now, here's the compelling thing, because if you say 5% is your downside, but you only have 5%, well, gosh, that's not a very great case to make for someone who's growth-oriented. I would suggest that you've got 5% downside and roughly 30% growth potential in the short term. Now, you have to stretch it out on a much longer-term basis, but I think from these levels, you're looking at maximum upside of about 300% in gold. So 30% in the short run, 300% as time marches on, and as that long-term bull trend plays itself out towards the final phase.
So, David, what you're talking about here is a 6-to-1 advantage on the gain side versus the downside. It's definitely an entry point for gold. What about silver?
Kevin, it's real difficult to be ambivalent here, but to me, it's as clear as a beautiful sunshiny day. 5% downside, 30% upside, you know where you want to be positioning liquid assets. On the silver side, you have both greater downside and greater upside. There's no technical support here. I think you're really looking at a relationship to gold, and when gold has experienced its maximum pressure and maximum selling, then silver will also begin to percolate up a bit in price. So, from current levels of 32 to 34, I think you'd have downside to, say, 29 to 30. Let's say you've got 9% downside from here, $2.75 from current levels. Kevin, if it's 9% downside, you're looking at a very short-term time perspective of 50% growth. And that's just getting you basically back to the old highs. This is not some pie-in-the-sky number grabbing or guesswork. I think you've got strength in these markets and weakness in the foreign currency and U.S. dollar markets, which will take gold and silver 30 to 50% higher in the next 12 months, not the end of this year, but certainly in the next 12 months. So by the time you get to the end of the first quarter next year, would not surprise me at all for gold to be 30% higher, silver to be 50% higher, again, with very minuscule downside from here. From a long-term perspective, 18 months and beyond, that's when you begin to see silver really outperform, because gold, yes, it has 300% ahead of it as a maximum number. I think silver probably has somewhere between 5, 15, 600% maximum upside from these levels. You're always going to have more volatility with silver. This is one of the reasons why we encourage clients to look at a balanced perspective, focus on asset preservation first. Don't be wooed, if you will, by the potential of greater gains, because with that comes greater risk. And we want our clients to be investing in a way that they're comfortable from one day to the next, from 1 week to the next, from 1 year to the next, knowing that they're going to finish this race strong. And the reason they own precious metals in the first place in a diversified portfolio to represent an offset to losses elsewhere, whether that's in the equities market or in the dollar market or whatnot, in their savings.
Well, and I think it's a great point to make, David, that we go back to maybe what you talked about last week and you've covered in other programs, and that is the equity relationship in the buying power of gold and silver, or, equity, be it real estate equity, be it equities in the form of stocks. The more you hold gold right now in this period of time, it really doesn't matter, does it, how much it goes up in paper dollars, because the paper dollar is going down. What we're really trying to accomplish here is how much more buying power do you have when you want to go out and buy a house or when you want to go out and buy more stock? Would you cover that relationship just briefly again, David?
Yeah, Kevin, because you're exactly right. That relative value is so much more important than any nominal increase in the price of gold and silver. I'll just relate a story to you. The other morning I was watching a Financial Times interview, and they brought on PhD economist from Standard Chartered. And this was a section on gold. And he shows a chart of gold going back to 1971. And he says, now this is probably very obvious to all of you. He was being very, very pedantic. He said, this is very obvious. You look at this chart of gold, and now you understand why we don't want gold as a part of any money system. Look at the volatility. Look at the volatility. And I'm thinking to myself, this guy is a PhD economist, and he doesn't realize that actually gold is simply reflecting the volatility, either the strength of the dollar or weakness of the dollar itself. This has nothing to do with gold being volatile. It has everything to do with the underlying currency and the fundamentals of the U.S. economy. You see, this is the major point, is that they're actually, and you hit the nail on the head, Kevin, because whatever happens to the nominal value of gold or silver, it's frankly pat yourself on the back for having all these great returns, but all it really is commentary on the death of your currency and a sad, sad story about the demise of an economy that once was a great leader in the world scene and is taking on a more and more diminished role as time goes by. That's what you're seeing, Kevin. That's what you're seeing. That is why this relative relationship, whether it's to equities, wherein your purchasing power in equities increases, that's the Dow-Gold ratio we so often talk about.
Well, David, I know a lot of people do own stock, and they're owning gold right now to own more stock down the road, but there's a lot of people listening right now who just want to know how much more house does it buy? You know, you brought out that just, 5 or 6 years ago, a little over 400 ounces of gold would buy a house, and now you can buy 4.5 houses for that same 400 and some odd ounces of gold. I mean, and we're looking forward to a time when it would buy even much more than that.
With both of those variables factoring in, both the depressed value of homes being one variable and the increased value of gold on the other.
So, David, I remember Sir John Templeton saying something before he passed away at the peak of the real estate market. He said when real estate hits 1/10 of what it's worth right now, it's a buy. Now, he wasn't talking about in dollars. He was talking about in real buying power. And what you just now expressed means that we're halfway there. I mean, you could, from one house to being able to buy 4.5 houses for the same amount of gold. If you're talking 9 or 10 houses, that's what John Templeton said years ago.
Kevin, I met with John Templeton down in the Bahamas back in 2004, and I had no idea what he was talking about. I had no imagination for real estate values in the United States being worth 1/10 their current value or losing 90% of their current value. But actually, in relative terms, not nominal terms, but in relative terms, we're halfway there, and actually we'll arrive there pretty quickly over the next 24 to 36 months.
Well, going back to the currencies, David, the dollar, you said short-term may be showing a little bit of a rise, but of course, David, that's relative to other currencies which are falling. The long-term relation to the dollar as far as buying other things is really going down. And you were talking about China divesting, the flows coming back out of the dollar in Chinese reserves.
And this is something that was several weeks ago, Kevin, that you and I talked about in depth, where it's actually not so much the TIC flows that we're concerned about. That's one of the fundamental variables that we do look at. But more important over the next 24 to 36 months is the transaction flows and the trade settlement, the invoice settlement outside or around the U.S. dollar. So, yes, in fact, we do have Treasury flows where there's a net liquidation just in the month of, from November to December, of $100 billion in Chinese liquidation of U.S. Treasuries. That is worthy of note. But what is of greater importance is how we are losing our significance. I mean, Kevin, it's like this. Let's assume that we once were the lead role in the play. Now we're simply an extra in the script. We're just standing around doing nothing. We used to have the lead role. Now we're just an extra.
Well, David, one of the things that's been fueling the economy worldwide, even as the rest of, the West continued to contract, was this looking towards China. You and your dad talk about it on a consistent basis. Where China goes right now, in a way, is where the world goes. And we're starting to see a slowing or a contraction in China. Can you comment on that?
Yeah, because it's really a fueling of positive sentiment. It's a fueling of hope. There really is no ability for the Chinese to be governing, directing, supporting, making up for the absence of Western Europe and the U.S. They have not converted to a consumption-oriented economy. They'd like to. They are taking and making great strides towards that end. But in the interim, no, they are not holding the world together. In fact, they're seeing an increased rate of decay, if you will. 7.5% growth rate for GDP, which is the lowest they've seen since 2004. And expected inflation was 3.8 to 4.1%. And actually, the natural number was 4.5%. Now, to give credit where credit is due, the People's Bank of China has masterfully taken the official inflation rate. I say official because just like our official rate, there's some doctoring to the number. But they've taken it and moved it from 6.5% down to 4.5%. Basically a 30% reduction. If you look at some of the inputs into their inflation calculation, Kevin, you can see some of them, it's particularly in food inflation, which was accounting for about 15%. They've been able to toggle that down to about 10. And for us, that actually is more of a real-world reflection of inflation in China. It was 15, now it's 10. Vast improvement, a one-third improvement, or about a 30% reduction, since June of last year. They are now in a much better position to handle a slowdown than Western Europe and the U.S. They've increased interest rates. They've got some monetary policy measures that they can take advantage of that we can't because we already have zero interest rates in place, as the ECB in Europe does as well. So actually, Kevin, if you're looking for anyone who is sort of stuck in a liquidity trap, it's the West. It's the West that's stuck in a liquidity trap, and the East still has several options if, in fact, they move into a significant slowdown. 7.5% growth rate is low for them, Kevin, but here's what the best analysts I read out of Asia would say. You can expect to see that growth rate decline to about 3% per year over the next 24 to 36 months. They're still growing. They're just growing at a slower and slower and slower pace.